Hey everyone, thank you for joining us for our webinar today. I'm Emily Marsh from the Greater Concord Chamber of Commerce. I want to let you know if you need more information after this webinar, we will be recording this entire session and I will be emailing that to everyone who registered for the event afterwards. So you can look back and review the information whenever you would like to afterwards. I also want to let you know about some other resources that the Chamber has to offer. If you go to our website, concordnhchamber.com, you'll see our COVID webpage. If you go there, you'll see links to many resources that you can take a look at that may apply to you or your business. So please check that out. You can also subscribe to our newsletter, and that will give you updates on additional webinars that you may be interested in. For the session today, if you have questions, you're going to submit them through Zoom's Q&A portal. So to access that, you're going to tap your screen or just wiggle your mouse a little bit and click on the Q&A button. From there, you can just type your question in and submit it, and that question will only be seen by me and our presenters. So it is an anonymous question, even though your name, may be associated with it, that we can see, but none of the other attendees can see your question. If you raise your hand during the session, I will reach out to you privately and ask if you have any technical questions. If you have a Q&A question, I'm going to let you know how to use that Q&A portal. Again, that is how we're going to get our questions today. So this webinar today is part of our Orr Reno webinar series. They have been an amazing supporter of the Chamber for years and supported us with many programs. And we're really excited that they came on board during this really challenging time to support us. They sponsor these webinars that we provide weekly. The topics are announced pretty last minute because we want them to be very applicable to what people's needs are right now. So to get the info on next week's webinar, you'll want to check out the Chamber's website, concordnhchamber.com, where we'll be posting next week's topic. So thank you to Orr Reno, and thank you especially to Rachael today from the New Hampshire SBA for joining us and sharing her really valuable insight for today's presentation. So with that, I'll let you guys kick things off. Thank you.
Thanks, Emily. So my name is Nat Morse. I'm here with my colleagues, Lindsay Nato and Tony Sayess from Orr Reno. We're going to talk a little bit about the Paycheck Protection Program with a focus on loan forgiveness. And I want to mention probably half the reason why many of you are here is that we really appreciate Rachael being available to help answer questions and give us the latest from the SBA. So to kick it off, I'm going to just very briefly talk about what the Paycheck Protection Program is, and then I want to talk about the logistics of loan forgiveness based on what we know so far and based on what we can understand from the guidance that has been issued. And then Tony's going to go over some of the special rules for self-employed individuals, which might apply to a lot of you that are listening. And then we're going to raise a number of open issues that we know some of our clients and some of the people that we've been discussing have had questions about and that have been raised a number of times. And then I think a lot of what we really hope is that this is going to be an opportunity for people to ask questions of us, and then also importantly of Rachael that are on their minds and that are kind of really pressing for them. So first of all, what is the Paycheck Protection Program? I think probably many of you know, the Paycheck Protection Program was created as part of the CARES Act at the end of March. Initially, it was a $349 billion program, which was really designed to keep small businesses afloat during this kind of uncertain period and was really focused through that June 30th, 2020 deadline. Obviously, as many of you know, the program ran out of money very quickly. But Congress recently refreshed that with an additional influx of $321 billion. And I'm not sure if that's all run out yet, but I will say that if you have not applied, we would definitely recommend, and I think Rachel would probably reiterate that, to start working with a lender right now to get that in. The goal of the program is really to keep employers from laying off their employees. And the advantage of the program, and as we'll see when we talk about kind of the loan forgiveness logistics, it's really to keep those employees on the payroll, to keep them earning money from these small businesses, and that because of that, you can get a lot of that loan forgiven, which would be tax-free. And then additionally, unlike some other SBA loans, there's no personal guarantee or collateral required. So moving on to, I think, what a lot of people are here, and especially for those of you that have already applied for and either been approved for or possibly even had those funds from your Paycheck Protection Program loan already dispersed, I think that the next question is, okay, how do we go about maximizing that loan forgiveness? And what can we do to plan ahead to really make sure that we're taking full advantage of the program? And I just want to start with a little word of caution here, is that we're really waiting on additional guidance from SBA on the logistics of loan forgiveness. I think that we're expecting, and I think, obviously Rachel will chime in, especially during the question period, about what guidance we do have, but we're certainly expecting more. I think that the expectation is certainly that we'll get substantial more guidance before the end of any borrower's 8-week kind of covered period. But especially for those people that have already had their funds dispersed, it's a little bit of, trapeze without a net here, that we're trying to base it off of what we know, and so there's a little bit of risk involved, and so we're hoping that this can be helpful and help address some questions that you might have, so that you can base it off of that. So with that said, we're going to present the information that we have with a giant caveat that some of this is definitely subject to change, and that if SBA comes out with additional guidance that seems very contradictory to what's in this presentation, obviously stay up to date on this, and as a firm, Orr Reno is going to keep putting out the guidance, but also pay attention to the SBA guidance for as that comes out. So what we do know is that Paycheck Protection Program loans should be forgiven as long as, number one, that the loan proceeds are used to cover payroll costs and other authorized costs over the 8-week period after the loan is made. And then number two, that employee and compensation levels are maintained. So if you use your PPP loan for those authorized purposes and you maintain your employees, the number and the compensation for those employees, your loan should be forgiven. So that's kind of big picture. To kind of drill that down a little bit, because obviously with the current situation, many businesses aren't able to satisfy necessarily both of those. And again, I want to mention, we're waiting on additional guidance, and then also there's special rules that have been recently released, first on, I think, April 14th, and then more recently, just a couple days ago, for individuals with self-employment income, especially those who file a Form 1040 Schedule C. So if you're not able to meet those two big criteria to make sure that your full loan is forgiven, you also need to be aware of why loan forgiveness might be reduced. And loan forgiveness would probably be reduced if a business, number one, uses the loan for anything other than payroll costs or those authorized non-payroll costs. Number two, uses more than 25% of the loan proceeds for non-payroll costs. Number three, reduces the number of employees. Or number four, reduces an employee's wages by more than 25%. And so we're going to talk a little bit more in detail about each of these four different reasons why loan forgiveness might be reduced. But first of all, what we're talking about with loan forgiveness is this 8-week period after the disbursement of funds. And so I want to take a step back in that the PPP loan program is a 2-year loan at 1% interest rate. So if you applied for the loan, it's a 2-year loan, and people need to remember that this 8-week period for loan forgiveness isn't the entire period for the loan. So at the end of that 8-week period, if you haven't spent your entire loan, that just matters for the forgiveness side of things. It doesn't mean that you have to return all of that money immediately back. So I just want to reiterate that we're talking about this 8-week period after the disbursement for the forgiveness, not necessarily for the entire loan. But during that covered period, what we're talking about for payroll costs is the same definition as when you were applying for the loan. So it's the salary and the wages, which are capped at $100,000 annualized per employee. We're talking about employee benefits, a lot of time, principally retirement and healthcare. And then we're also talking about state and local taxes, which are assessed on compensation. We're not talking about the employer FICA taxes, things like that. And then in addition to those payroll costs, which you already were looking at for the application, you're also able to use the PPP proceeds for other authorized uses. And these include mortgage interest, rent, and utility payments. And all of these other uses had to have existed. The obligation had to have existed on February 15th, 2020. So that's something to keep in mind, especially if you had a recent change in location or other factors. You're going to want to make sure that existed prior to that date so that it is included in that authorized use. And then additionally, if you are self-employed individuals, you're going to want to look at some special rules related to those other authorized uses, and you're going to want to read some of that guidance more specifically, and Tony's going to talk a little bit about that too in a little bit. So as long as you use your PPP proceeds for payroll costs and those authorized non-payroll costs, you also want to make sure that you're using 75% of that on payroll costs. And so this 75% forgivable amount of that. And so what you need to make sure when you're using your funds is that at least 75% of what you spend during that 8-week period is on payroll costs. And again, wages, compensation, benefits, and then trying to limit what you're spending for authorized non-payroll costs to 25% or less. And again, anything that you're using for unauthorized costs, which would be not included in these other categories, would obviously not count as that 75% payroll cost and also would not be forgivable. But so, just to back up, if you spend less than 75% of your loan proceeds during that 8-week period on payroll costs, so if you spend 70%, for example, based on what we understand, it wouldn't be that you wouldn't be able to have any amount forgiven. It would just be that the forgivable amount would be reduced such that 25% of the non-payroll costs, the amount forgivable would be capped so that 25% of your forgiveness would be for non-payroll costs. So it would be shifted down. If you spent, for example, $70,000 on payroll and $30,000 on non-payroll, it would be reduced so that you had $70,000 of payroll costs and then 25% of the total amount forgivable for non-payroll costs. So that's something you're going to want to keep in mind, but you're going to want to shoot for 75% spent on payroll costs to maximize that forgiveness. And then the other way that forgiveness can be reduced is that if the business reduces the number of employees. So the amount of loan forgiveness, we know that the amount of loan forgiveness will be reduced if the borrower reduces its workforce. And unlike with the payroll versus non-payroll costs, there's no threshold like the 75%. The loan forgiveness reduction is going to be proportional to the reduction in full-time employee equivalents. And this calculation is based on comparing your average workforce during the 8-week covered period with one of two comparison periods. So you're looking at either that February 15th through June 30th, 2019, or you're looking at the first 2 months of 2020. And the borrower gets to elect which of those. You're going to want to calculate your FTE for both those periods, and then presumably you're going to want to select the lower FTE amount as a comparison. And so the way that this would actually be calculated is that you take that potential loan forgiveness amount, which again is that the amount that you spent on payroll costs and authorized non-payroll costs, which might be potentially reduced if you didn't hit that 75% threshold. But then you're going to multiply that by this quotient where you're looking at the average number of employees during that 8-week period, which is calculated based on the average from each of the pay periods, based on what we know. And then you're going to divide that over the average number that you had during one of those comparison periods. So if you had a 10% reduction as compared, then your potential loan forgiveness would be reduced by about 10%. But we also know that there's floating out there that any reduction can be reduced or reversed if the employees that were laid off or furloughed or whatever between February 15th and April 26th are rehired by June 30th. But we're waiting on more information about how specifically that reversal or that rehire exemption is going to work and how that would be implemented. So especially if you're in the beginning of your 8-week forgiveness period, you're going to want to try and maximize the FTE rather than necessarily relying on that, just because there's a lot of unknowns regarding that June 30th date. And then the last way that your loan forgiveness can be reduced is if you have a reduction in employees' wages by more than 25%. So we know that loan forgiveness will be reduced based on the actual amount of salary reductions greater than 25%. Again, this isn't a proportional reduction similar to the headcount, the FTE reduction. This is going to be based on what we know, a dollar for dollar reduction. And this only applies to employees with annual wages of $100,000 or less. And the way that you're going to want to quantify that impact for planning purposes is, first of all, you're going to need to identify if employees had any reduced wages or salary. So if everybody's maintaining the same salary, then this isn't going to matter. But if you had to reduce salaries, then you're going to want to identify which employees had reduced wages, number one. Number two, you're going to exclude anybody who was making more than $100,000. And then third, you're going to calculate the annualized rate for those employees during the first quarter of 2020, and then also as a comparison, the 8-week covered period. And the reason you're calculating the annualized rate is because you want to be comparing apples to apples. Obviously, the first quarter is a 13-week pay period. The 8-week covered period is 8 weeks. And so you're going to want to make sure that you're comparing that to apples. And then based on that annualized rate for those two periods, you're going to calculate that percent reduction. And if the reduction is greater than 25%, you're going to calculate the actual difference between current pay and that 25% reduction. If the reduction is less than 25%, then there's going to be no impact. But if the reduction is greater than 25%, then you're going to calculate that difference in what the salary would be based on a 25% reduction. And I want to reiterate here that based on what we understand, you're comparing it to that 25% reduction. So it's not compared to the full salary that they would expect to receive if there wasn't any change. And then based on that, you're going to add up the actual salary reduction for all employees, those actual dollars. And so I'm going to just run through kind of a quick example that we put together. If you're looking at 4 employees who were all making $40,000 a year during the first quarter, if we look at the wages that they actually got paid during that 8-week covered period, which ranges between $3,000 and $6,000. If you annualize that 8-week period up, you can see that the annual salary ranges between $39,000 and $19,500. So the person who had an annual salary of $39,000 was only a reduction of 3%. So obviously is less than that 25% threshold. The person who got paid the annual rate of $26,000, it's a reduction of 25%, which again isn't more than 25%, so it doesn't impact the forgivable amount. The person who received $4,000 during that 8-week period had a 35% reduction in their salary, and so that's greater than 25%. So you're calculating the difference between what they made during that 8 weeks and what they would have made at the 25% reduction. So you can see it's a $633 difference. And then the last person had also a greater one, and so you would include that 633, that 1,633, and that's the total amount of your loan that is then not forgivable. The one mention I'll make on this is something that especially as you're moving forward, you might want to consider, is that amount that you're not paying to your employees is then also not forgivable. If you pay and make sure that you maintain their pay at no less than 25% reduction, then you're not going to have any impact on the forgivability of that payroll. So it might be something as you're thinking about how to use your funds to keep in mind that 25% number. And then just in terms of documenting the loan forgiveness, what we know right now is that after that 8-week loan period, the borrower is going to need to submit an application that seeking that loan forgiveness. And I don't think that anybody's seen, at least, well, nobody that I'm aware of has seen what the application will look like. But what we do know is that it's going to include some documentation. So it's going to include some documentation about payroll and the full-time equivalents that's going to be needed. And this is going to include tax filings to the IRS and or the state at a minimum. You're also going to include some documentation about those authorized costs. So if you spent money on rent, you're going to need to document how that rent was spent, how much it was. And this could include canceled checks, receipts, whatever is going to be relevant for what was actually used. And then additionally, the borrower is going to have to certify as to the authenticity of that application. So that's something to keep in mind as you're putting your planning, is that this is going to include some certification, and you're going to need to be able to basically make a statement that what you're submitting is true and is accurate. And then finally, there's going to be other documentation that the SBA determines is necessary. And then also there's going to be documentation that your lender, who's going to be the one actually receiving and processing that application, is going to need. So you're going to want to make sure that you maintain a dialogue with your lender to make sure that what their expectations are you're aware of what their expectations are going to be based on that application, because it might differ a little bit based on what other lenders are going to need or going to want. And so I want to turn it over to Tony right now to talk about some of the special rules for self-employed individuals.
Thanks, Nat. Yeah, so we're still, as we said, waiting for a lot of guidance from SBA on the loan forgiveness issues. There's one, one type of borrower, they actually have issued some, limited guidance on forgiveness, and that applies for Schedule C filers. So what is a Schedule C filer? Generally a self-employed individual. They might consider themselves an independent contractor. It also could be a person who owns an LLC with a single member, and the income from that trade or business is reported on the individual's Schedule C rather than a separate LLC tax return. So that's what we're talking about. So we have some idea of what will be used to assess how much forgiveness on PPP loans for Schedule C filers. The guidance provides there could be full forgiveness up to the full amount of the loan taken out, plus accrued interest. And one issue that there were a lot of questions on before was, hey, what is owner compensation for a Schedule C? And so guidance was issued a couple weeks ago, and it really focuses on 2019 net profits from a certain line on the individual's Schedule C. I think it's line 31. But basically you look at net profits for 2019. And what is going to be allowed is 8 weeks worth of that 2019 net profit. So basically, 8 weeks out of 52, and you divide 8 by 52, you get 15.38%. So you look at that line on the Schedule C, and you would be able to take 15.38% of that number, subject to the $100,000 cap. So we're talking a maximum of $15,000, assuming that the net profit of the Schedule C was higher than $100,000 in 2019. So they're not looking at 2020 and what's going on in 2020. They're looking at what's happened in 2019. It doesn't include things like benefits for a self-employed individual. If the self-employed individual had employees in addition to themselves working at that activity, you would still include those employee compensation numbers in the overall formula for payroll costs, in addition to the owner compensation replacement amount. And you would, for those employees, you would include things like benefits and retirement, just not for the owner. And so there's been a lot of talk about whether you look at whether there's a draw taken or cash taken from the business. So I think that that's evolved a little bit, where they really isn't looking at what the cash that was taken out. It's really looking at that one line of the tax return. So one question is, well, I've gotten my PPP funds, and so should I take a draw from my Schedule C business? And I think that's, there's some in more recent guidance, there's some mention of maybe looking at how much money was taken from the business, but for a lot of Schedule C, it's just one bank account. And so how would you take money out of that to pay yourself? And one idea might be, I don't know, if you have a checking account, a savings account, every week moving some money from one to the other to show, oh, that's my draw. And at the end of the day, it's going to get up to that 15% of that 2019 amount from the tax return. So other things, you still need to hit that 75% threshold, but other things that the Schedule C activity can use is for mortgage interest, especially for something like if they use a home office and they claim part of that mortgage interest deduction on Schedule C. The important thing is it had to have been taken on the 2019 Schedule C. The same for rent and same for utility payments. We've had some question on, well, what about rent to a related party or related entity? And I've seen nothing that can't be taken, especially if it was taken on a 2019 Schedule C. And clearly it had to have been in place before February 15th in that case for the 2019 return. So again, the 75% has to be used on the payroll and owner-employee replacement during the 8 weeks for Schedule C activities. And similarly, just as Nat mentioned, there will be borrower certifications needed. If there are employees, there will be other reporting requirements to show that those employee wages were paid during the 8-week covered period, as well as other types of evidence of retirement or health contributions. In addition, things like the business rent, mortgage interest, utility payments will also be needed at the time of the application for forgiveness. So one question that we've gotten has been, okay, we understand there's this, pretty good guidance that exists now for Schedule C, which could include a single member LLC. But what if I have a multi-member LLC and it's taxed as a partnership? So just Friday night, some point, guidance came out basically for all the different types of tax filers: self-employed, partnerships, S corps, C corps, nonprofits. And the guidance was really geared towards, hey, how do I get my maximum loan amount? It wasn't really geared towards forgiveness. But in looking at the calculations for how to get the maximum loan amount to be borrowed, I think it does provide something of a roadmap for how the forgiveness calculation might be looked at in future guidance on forgiveness. So specifically for partnerships, this new guidance does also talk about owner compensation of partnerships, and it looks to net earnings from self-employment for individual US-based general partners subject to self-employment tax in a particular box 14A of form K1. So, you know, there's been issues about, hey, do I use my draw? I was a partner in a partnership or in an LLC. Do I use my draw? And really this is saying, no, you actually look to box 14A on K1 and you make some adjustments based on that. And so my best guess, and it's just a guess at this stage, is, you know, when this guidance comes out on forgiveness, there's going to be similar logic applied to partners and, you know, owners of multi-member LLCs as for self-employed individuals. And they're also looking really only to those partners that are subject to self-employment tax. So you might be a purely passive member in an LLC and not have put anything on a 2019 14A, taking the position that you aren't subject to self-employment tax. And, you know, that member might be shut out from the employer compensation payroll formula. And similarly for, you know, as in the self-employed context, I think it would be this calculation of, you know, 8 weeks out of 52 weeks. So 15% of whatever number is in that box up to the 15,000 for people making over 100,000.
Right. So then, just briefly before we go into some opening it up for questions, I just want to mention some of the open issues that people that we know based on some conversations that we've had that a lot of people seem to have questions about. So one of those is how many hours is FTE. So the FTE calculation obviously is important in determining the potential reduction due to a drop in headcount. But when you're looking at potentially, you know, combining multiple part-time employees for that FTE calculation, or vice versa, it's unclear whether the SBA is going to be using that ACA 30-hour threshold for FTE or the 40-hour definition of an FTE. And so I think that's something that we've had a number of people that have asked questions about that's currently unclear. I think also a large question is how is the SBA going to interpret incurred and paid? Does an expense under your loan have to be incurred and paid during that 8-week period, or just incurred or paid? How is that going to be considered for this forgiveness calculation? And you can certainly see how that matters for things like monthly expenses like rent or utility bills. Obviously, if you pay the rent for what month, May, and it's fully within that 8-week period, you know, there's no real question there. But what about for if you get dispersed in April and you have a couple of weeks of April rent that was paid, you know, before you got the loan, or on the other side for June where you paid the rent, but it's not necessarily all of June doesn't fall in it. How is the SBA gonna be considering those for forgiveness? Additionally, you know, when should you first use your funds for payroll? If your lender disperses the funds in the middle of the pay period, this is something that many of you might have you know, kind of come up against. Can you use that to fund the next payroll, part of which was accrued prior to the disbursement, or do you need to wait until you're funding the payroll, which was fully incurred after that disbursement? Can you use the PPP funds for cell phone plans? You know, the guidance that we have says telephone is an authorized non-payroll cost along with electricity, gas, and other utilities. But does that include just landline phones, or does it also include cell phone plans? And then a lot of people have questions about, what do you do if your employee doesn't want to return to work? What flexibility do you have to increase pay to, quote unquote, match unemployment pay because of that $600, added benefit from the CARES Act. And then on top of that, should you, and, partly that's a little bit of a business decision. It's going to depend on your factors. But is that something you can even consider under the SBA, under the PPP program? And I think generally the thought is yes, but it would be nice to have some clear guidance that is. And then additionally, if your employee doesn't want to return to work, can you hire a replacement? When you're looking at FTEs, the kind of the breadcrumbs that we have is that it doesn't matter that it's the same person that you're rehiring to replace, that it's purely just looking at kind of that overall number. But again, how it's not 100% clear for that. And then additionally, how do you handle health insurance payments? Is the SBA going to be looking at those costs that are deducted from the employee paychecks, or if your business pays, kind of a monthly health insurance premium, which one of those, how is that going to be looked at by the SBA in evaluating forgiveness? And then I think one of the biggest questions is that June 30th rehire date. Just how is that going to work? It's kind of out there as almost like a get out of jail free card that some people are viewing it as. But what are the actual aspects of that the SBA is considered? Is it literally one of those you just have to hire them on June 30th and then you can lay them off on July 1st to qualify for full reduction? Is there going to be something that you're going to have to certify that you've rehired the person and they're going to be kept on and for a certain amount of period? Does it have to be the same employee? Do you have to rehire somebody who was laid off during that period in the statute, and then that specific person has to be rehired? And then also, what if you don't rehire all of your laid off employees? If you have 100 employees that you laid off when your business essentially got shut down, and you rehire 99 out of those 100 by that June 30th date, but you don't get that one because they're holding out for whatever reason. Is it a take it or leave it type of a deal? Is it going to be a proportional? We just don't know how that is going to work. And so that's why there's a lot of uncertainty related to it. Similarly, that June 30th salary increase, do you have to, how's that going to work? Do you have to raise the salary back to 100% of the kind of look back period salary, or are you going to have to just raise it back to above that 25% reduction, which is what's used for the forgiveness calculation? So I think those are some major questions related to that June 30th date that we're waiting on. And then obviously there's a lot of other questions, especially without having seen the loan forgiveness application. What else is going to be included? What other considerations do we need to be aware of? And obviously getting as many of those answers is going to be helpful, but in the meantime, just trying to keep in mind. And then obviously I'm sure that other people have a lot of other questions, which is why we've got hopefully a bunch of time for questions. But just in conclusion, I wanted to, just based on what we do know, as you're kind of leaving the webinar and after, we get our fill from all of Rachel's guidance, a couple of just practical tips to keep in mind. Number one, apply for a loan if you haven't already. Number two, spend the loan on payroll and authorized uses. Try to spend at least 75% of the loan on the payroll. Minimize any FTE reductions that you can, and avoid reducing the salary greater than 25%. And then if you do have to minimize, or if you do have to reduce your FTE or salary, try and rehire or eliminate those by June 30th. And then I'll just put a quick plug. If you're planning or you're doing some thinking about how your loans are going to be used and how it might affect your loan forgiveness, we did try to put together a kind of an estimator that takes into consideration some of the latest guidance. We're trying to keep it updated as new guidance comes out, to try and help you work through some scenarios where it's okay, if I give everybody, a bonus, this increases my payroll costs by X amount. How does that affect your total forgiveness? Just trying to work through those scenarios might be helpful. And that's on our website. The link is there, but also if you go to our homepage, you should be able to find it, hopefully. And so at that, we're just going to open this up to questions to any of us, or potentially more interesting from Rachael, and use the Q&A chat function. I know Lindsay has been furiously typing as they're all popping in. So she's, I'm sure, got a good list, but if you've got other questions, include them in there.
Thanks, Matt. We do have a lot of good questions, so we will jump right in. A couple of quick ones that I can answer. Yes, the Chamber will be sending out the slide deck after this. And yes, we will be doing future presentations once we do have more guidance from the SBA on forgiveness. So more to follow. In the meantime, we'll do our best to answer your questions. First, what is, just some basics, what's the interest rate of the PPP, and when do you need to start paying that interest on the loan?
Okay. Do you want me to take that question?
Sure.
Okay, sure. So the terms of the unforgivable portion of the loan would be 2 years at 1% and is a 6-month deferment period. That's part of that. So that is what we don't know, and we're waiting for guidance on, is what people can spend that part that they're not using on the payroll and that actual other expenses. What's going to be allowed to be for the balance of that loan to be used. We don't really have a clear guidance on that, if people can use it for anything or it's going to have specific uses tied to it. So before I get started on answering any other questions, I just wanted to thank Emily for having me, and Nat and Tony, you did a great job of putting all of that together based on the guidance that we have. So it was a great overview. So good job, guys.
Thanks for joining us, Rachael.
Sure.
Will there be opportunities to convert the PPP loan into a longer period of time if you're not able to pay it back in the 2 years?
Not with the way the current rules are written. No, that would require changes to the legislation.
And we have a lot of questions, not surprisingly, on forgiveness, and specifically how to calculate some issues. So we'll run through those. When does the 8-week period start, and do we need to calculate all of those forgivable expenses starting on day 1?
So the 8 weeks starts when the loan is dispersed to the business. So if you can work with your lender on getting that closed and dispersed at the beginning of a pay period, that makes the documentation easier. But that kind of starts the 8-week clock is on, they're calling it first disbursement, but I think the majority of these are going to be one disbursement. They're trying to close them within 10 days of getting the SBA approval and dispersing them pretty immediately.
And Nat touched on a few of these, but can home office, mortgage, and utility payments be counted for forgiveness?
Yeah, I think Nat answered that, or Tony, but basically, if it was a business expense that you typically take based on 2019, if you typically take mortgage interest because you have a home office or you have utility costs, and I would say, even though it didn't call out cell phone plans, if that's a typical business expense that you have taken in 2019, I would say that's going to be an allowable utility expense. But again, they're going to look to what the historical, what historically you've done. You can't automatically decide, oh, well, in 2020, I'm going to start using my personal cell phone as for business, so I'm going to include that. It's going to be, if you've included it in 2019, that can be part of the forgiveness for the PPP.
This person asked, I got a PPP loan and 95% should be covered by payroll costs, but what are the guidelines for taxes? I understand gross pay is forgivable, but how should I handle matching Social Security and Medicare?
So you take this?
Yeah.
So the amount of taxes that were taken out on the employee side, those are included. Those were included as payroll costs, even though the employee didn't receive those and they went to the IRS. It's treated as if the employee got it, but the employer side of those FICA taxes are excluded.
And Tony, what about a partnership LLC as far as owner compensation?
Yeah, I mean, as I touched on, we don't have exact guidance, but you know, I do think that based on what came out Friday night, that they're going to look to the K1 from 2019. I think that it's line 14A. It's the self-employment compensation of what they term to be a general partner for a LLC that's taxed as a partnership.
Here's another question about forgiveness. Do rent payments to a related party qualify for forgiveness?
I think that as long as it had to be in place by February 15th, 2020, and depending on the type of tax filer it is, whether they included that as a deductible expense in 2019. But I've seen nothing that says you couldn't have a related party expense.
I would agree.
And should that be done at fair market value?
It should always be done at fair market value if you're deducting it for taxes.
Can payments on leased equipment be forgiven?
I think that's a gray area for, I mean, in the sole proprietorship, they talked about like interest on autos and interest on other equipment. I don't think it's clear right now.
I think that from reading some of the tea leaves, that's an acceptable use of the PPP funds, but whether it's going to be included in forgiveness is, I think, an open issue, but I think it's not clearly stated that it can be.
Yeah, I think they said some other like debt service too could be covered with the PPP, but that would not be forgiven. So I think they're going to allow some uses of the PPP that are not going to be forgiven. So we're still waiting on that to be clearer.
We had a lot of questions about full-time equivalents and how that's all calculated. So if you can say exactly how will that work? What if your company's FTEs drop during the 8-week period? Nat, this might be for you.
Yeah, I mean, if you, so, and Rachel, correct me if you understand it differently, but based on the guidance we have is you're going to take your FTE during each pay period, during that 8-week covered period, and then you're going to take the overall average FTE for that calculation. And so if your FTE drops during the PPP, then that would be taken into consideration based on, you know, the average of those, whether it's 4 or 8 pay periods. On the other side, if you increase your FTE during that, so, you know, if you're able to rehire people starting in, you know, May or something, then that would also be reflected in that average FTE. So I think that's my understanding of kind of how that calculation is going to be.
Yeah. Yes, I agree. I think they're going to take an average of the covered period, so by pay period of the FTEs, and then they're going to compare that to the first quarter of 2020 FTEs. The way they're going to calculate FTEs has not been decided yet, or I haven't seen guidance on that, or whether it's going to be 30 hours a week or 40 hours a week. But I think if you're using the same way, if you're measuring it the same way on both ends, then you're gonna know whether you're going to meet that 25% drop or not. If you're using 30 hours, you just want to make sure you're using 30 on both calculations or 40 on both calculations to make sure you're staying within that 25% reduction.
And are part-time employees included as part of that?
Yes, they would be proportionately. So
How
part-time employees could count as one full-time employee.
how are voluntary departures being handled with payroll reductions? So if someone leaves voluntarily, does that still potentially reduce your forgiveness?
Yes, I think so. I don't think it matters how they leave. I think they're just doing the head count. Do you both agree?
Yeah.
Yeah, I haven't seen anything that exempts like, voluntary departures. I think it's just looking at the kind of the big picture snapshot.
Yes.
We received a few different questions about bonuses, and I know Nat touched on this, but are there any issues paying an employee's bonus during the 8-week period if it's typically done at year end? Can it be paid in full or should it be prorated for the 8 weeks?
I mean, it makes sense to have it prorated because you're going to, basically you came up with the average of your payroll for 2019. So that would have included bonuses and salaries and coming up with that calculation up to that $100,000 max. So I would think you would pay them a prorated portion based on that 8-week period.
If I reduce an employee by 50% but hire another so the number of FTEs remains the same, will this negatively impact my forgiveness?
I think it would be fine to do that.
Sorry, go ahead, Rachel.
Okay. No, I think you could, if somebody's only willing to come back 50%, you can hire another person to make up the FTE for the other 50%, if I'm understanding the question correctly.
And does it matter when you bring people back during the 8 weeks?
I would say yes, just because you're taking that average. So if you have, if you bring somebody back at the beginning of that 8-week period, they're going to count more for that FTE than they would if you bring them back in that last pay period. And so that could affect your forgiveness. And on top of that, it's going to affect how much payroll you're spending on it too. So.
Yeah, I think the sooner the better. The closer you can get to that loan disbursement, the more benefit the business is going to have on the loan, because your payroll expenses, the higher your payroll expenses are, the more you can use that other 25%, because it's going to, you're increasing your base of the payroll expenses. It's going to make the 25% for the non-payroll expenses amount larger for businesses. They get them back quicker.
One thing that's come up a few times is what to do with employees who are making over $100,000. Are you just supposed to cap them, or do you completely exclude them from your loan calculations?
No, you would cap them at the 100. You would not exclude them from the calculation.
I know there's some question about whether the 100 includes the benefits or not. And so the 100 is just their kind of wage compensation. You can additionally pay them retirement and healthcare, and those should be included.
Yes.
And do you include overtime with that?
I would say so. If it would be part of the payroll, your payroll expenses. You could include overtime. I haven't seen anything restricting that from the guidance that we have so far.
If you can pretty easily show that most of your forgiveness is for payroll costs, will you need to submit other documentation about those other allowable expenses, or do you just need to kind of meet that 75% threshold?
We still don't have guidance on that, but I would say that if you use 100% for payroll, you probably don't have to provide that other documentation. But if you're using any of the funds for the other stuff, you're probably going to have to provide documentation, or be ready to at least. You may just have to certify to that. We don't know yet. But I would be prepared to submit documentation for anything that I use the loan proceeds for in my forgiveness package.
Are you suggesting that companies set up a separate bank account to track all of their expenses? What's the best way to handle that?
We have heard people are doing that to make it easier for them to do. That is definitely not a requirement. It all depends on personal preference, I guess, on how you want to track. If there's an easier way for you to track, you're just going to have to really be, documenting how you're spending that money and being able to pull that documentation out at the end of the 8 weeks. Whatever makes it easier for people. But I have heard of people doing a separate bank account.
Rachel, do you have any idea when the forgiveness application might come out?
No, hopefully yesterday would be my preference, but we don't know. We're being told that one of the issues with this program is, first of all, it's a brand new program that SBA rolled out in a very short time. And to make it more complicated, it's not just an SBA program. We're doing it with the Treasury jointly. So all of this guidance has to be approved by SBA in Washington and the Treasury. So it's taking, they have gotten a lot of stuff out in a short period of time, but I think that's kind of the holdup, is it has to go through 2 agencies to get approvals and all of that. But we're hoping, sooner than later, hopefully within a week at the latest, because we realize that the 8 weeks is ticking for people, and they want to make sure that they're using the loans as they're supposed to get maximized forgiveness. So we need this guidance out soon. So we're hoping any day now.
You mentioned that 8 weeks, Rachel, is if a business is closed voluntarily or by governor's order, are they able to push that 8 weeks out to the time when they reopen, or does it have to start now?
It has to start when they get their loan proceeds. So we've had a lot of questions about that. And I know in the second go around, some of the senators tried to get more flexibility with that 8 weeks, but they did not get that through. So it's 8 weeks from loan disbursement that they're looking at. And I know that doesn't make a lot of sense for people that have closed businesses and that type of thing, but that's what we're dealing with, unfortunately.
Tony, does the PPP cover paid sick leave?
Yes, as long as they're not taking that other credit that's offered. I think do you guys know the name of it? It's the
Families First Coronavirus Relief
Credit. If they're taking that Family First credit for people that are on that they're getting that 1-for-1 credit on that has to be excluded from the calculation. But if not, then all paid leave is eligible.
Or here are some questions about the PPP loan and having employees on unemployment. With the new $600 in unemployment benefits, can an employer increase pay or add a resigning bonus to get its employees back?
That's a tough one.
Yeah, I mean, they can. I think the only restriction that I've seen is you can't reduce the pay. It doesn't say anything about increasing the pay. And I think a lot of companies are looking at that to try to offset or combat that extra $600 people are receiving on the unemployment side. I'll let you guys chime in as well.
Yeah, I'll say that there's definitely no guidance that says that you can't do that. And there's also no guidance that says that you can do that. So we're left with, if that's a business decision that you need to do to get these people back, I would do it. And we'll wait and cross our fingers for the guidance.
I would add just one thing is just be aware of that $100,000 annualized. So especially if you're a bonus, it might be better to split that over multiple pay periods so that you don't go above like $100,000 kind of cap for a single, especially if you can avoid going over for a single pay period. I think that might be conservative way to approach that.
Yeah, and it might be the case that guidance might come out in the next couple of weeks, So maybe you want to hold off on implementing something like that until, you know, sometime in the second half of May, maybe, when we know more. If you've run the numbers and there's some way that you have with, you know, spending the money.
And I see it's 11 o'clock, so we will invite Emily back in. But thank you again, everyone, for your questions. I'm sorry we couldn't get to all of them, but we will hopefully be doing another webinar, and we'll have more time to answer your questions. Emily?
Right, thank you guys so much for your presentation. I think Rachel may have had to run. She's very busy, as I'm sure you all know, but I really just want to extend a thank you to her for being here today, and of course to Orr Reno for sponsoring this series and sharing this information with people on a weekly basis. Again, I'll be following up with people after the webinar. If you registered, I will email you a recorded version of today's presentation. You'll also receive a copy of the slides. So thank you again for being here today, and glad you all could attend this session.
Thanks, Emily.